And notice that gap opening up more and more, right? I like to say Singaporeans, two hobbies, right? Save money and buy property. As you can see, ever since 2013, the institution of ABSD, last time they don't keep so much cash because they got money, they just buy property because they can leverage 90%. But now you cannot buy anyhow buy anymore, right? ABSD is so high, so what? They continue to save, save, maximum buy 2 then continue to save. We are essentially in a net cash position, so all the cash available in the Singapore real estate market, they pay down all the debt, they still have spare cash. And before we head into what I expect would happen in 2024, as usual, I like to build off the fundamentals of the Singapore real estate market a little bit more, and as my favorite, I like to utilize the MAS Financial Stability Review just because of the sheer amount of data that they provide that is undisputable. So now let's take a look, and I'm going to zoom in more into the real estate part to things, okay? Housing loan growth has moderated amid higher interest rates, and this one as expected because volumes have come down, which also means housing loan will also come down now, okay? As we can see over here, right? Similarly as with housing loans coming down, volumes coming down, right? The rate of increase of housing loans will taper off over here. Quite a good chart is something I refer to quite a lot. It's the loan to value. So this is the average loan to value for general Singapore household. So while MAS allows a maximum of 75%, if we average across the board, it's just 41%, which kind of explains why the market didn't really tank despite the sharp increase in interest rates, okay? And also kind of explains the very little small correlation, or as a matter of fact, little to no correlation between property prices and interest rates in today's market already. Strong household balance sheet and adequate liquidity cushion the impact of higher interest rates. So over here, this chunk of words summarized into a couple of tables, okay, charts. Number one, household wealth continue to go up okay, while the rate of increase is not as high as it was in 2021 because that's kind of correlated to the sharp spike in real estate prices. This is quite a good one. I always refer to this one. So this shows the cash versus household debt, and notice that gap opening up more and more, right? I like to say Singaporeans, two hobbies, right? Save money and buy property. As you can see, ever since 2013, the institution of ABSD, last time they don't keep so much cash because they got money, they just buy property because they can leverage 90%. But now you cannot buy anyhow buy anymore, right? ABSD is so high, so what? They continue to save, save, maximum buy 2 then continue to save. We are essentially in a net cash position, so all the cash available in the Singapore real estate market, they pay down all the debt, they still have spare cash. Again, another reason for the low correlation between interest rates and property prices, okay? So here the Singapore personal saving rates remain high relative to its long-term average, right? So 34.6%. People save 34.6% of their income. Over here, so this is for the ones that like to wait for fire sale units. So this one, conclusion is you can wait but the percentage is over here. Non-performing housing loans 0.2% of all the transactions, okay? And the 10-year average is 0.3%. Basically, if you want, you can wait but chances are not very high, right? So while more households face higher debt servicing costs, the impact remains manageable. Before the cooling measures were instituted in 2013, the Singapore real estate market, Singaporeans only took up about 65%, less than 70% of the market. What that means, right, is that we are very susceptible to external shock, and also because inflow and outflow of funds dependent on interest rates. Interest rates are high overseas. People move their funds, sell their property, move their funds overseas. So the higher the percentage of non-Singaporean participants in the market exposes the real estate market to more external shocks. That's the conclusion. And ever since 2013, notice, right, that the percentage of Singaporean participation in the real estate market start to go up. right? Non-resident demand has fallen with the increase of foreigner ABSD. So all in all, this trend shows that we are more sort of self-sufficient in terms of our real estate market, more protected from external shocks, primarily cushioned by the cooling measures. And so here's the outlook, right, and the summary of the households are in healthy position, right, but should manage their debt prudently in view of the heightened uncertainties ahead. Similarly, that is most of the developers are concerned about. And if you were to really want to read, probably you can read this part if you have some concerns about interest rates and mortgages, right? Because this is what they really dive into, and they have some pretty interesting data points. They break down, okay? 40% of all the mortgages are on floating rate loans, 30% are on board rates or fixed deposit rates, and 30% are on fixed rates, right? So we see over here 70%. So this is the key difference between the 2022 Financial Stability Review, which have a general, the tone of which will be like, you know, we gotta wait and see on the pass-through rate, right? Pass-through rate means like, because there's sort of a delay between the rise in interest rates and versus how it's actually felt by the Singaporean households, especially for those on fixed rates, right? They need to wait for the fixed rates to lapse before they actually feel the increase. So in 2022, high percentage haven't yet feel the pass-through, right? But now 70% already feel the pass-through rates, and what MAS is saying, they are weathering it pretty well. So this is the percentage breakdown. So 30% fixed rate. So 60%, basically 60% of them are on this kind of rates that don't fluctuate as much. Only 40% of them are on floating rates that are more exposed to fluctuations, okay? So the household sector has weathered the rise in the mortgages well. Some pretty good data as well, because you have seen over here, right? Total monthly debt repayment as a share of income for households for new mortgages have been relatively stable, with the median at a healthy rate of 43%. So what that means, right? 43% of household income is utilized to service the mortgages. They're on the median level. So over here, quite technical, but you see here the total debt servicing ratio. So while more monthly mortgage installments for new loans have increased significantly as expected with the increase in interest rates, but overall it's still a very healthy total debt servicing ratio. So what MAS stipulates 55%, the average is only at about 40 something percent. So this is another one, right? And this one I think maybe we can illustrate it using the charts over here. More than half of the mortgages have less than 20 years remaining in the lease, which means that Singaporeans are paying up a lot of their loans. And this one is quite common sense also, okay? Basically, the lesser the years, in terms of the loan, right, the lesser the outstanding loan, right, quite naturally so. So this one I think is not bad. It's quite a good correlation between increase in income versus increase in mortgages, okay? So MAS conducted a simulation to assess the debt servicing ability of households, okay? So first scenario, assume that face a higher mortgage of 4.5% in 2024 upon the refinancing of their previous rates. So they will face an increase of $790, about 7.5% of their income, but incomes have risen 10%. So which means the income risen more than the mortgage increase, so that they should be able to weather it pretty well. Next up, right, they use a more serious scenario, okay? Interest rates go up 5.5% alongside a 10% loss in income. So this is quite a scary or quite a strong stress test. The results show that households would be able to still service their debt even under such stress, although a small segment of highly leveraged ones, right, this form about 5% of total mortgages. Yeah, so you see MAS, they really go through very stringent stress tests and just to make sure that do we need to do more cooling measures and whatnot. Is the Singapore market over leveraged in that sense? So they have all these data points that they're consistently tracking on a year-to-year, month. I don't think they do it on a yearly basis only, right? They do it on a month-to-month basis to see if they need to do anything to it. And so here's the sum up for you to read. So the degree of stress arising for potentially higher for longer mortgage rates vary according to the loan profile of borrowers' characteristics, right? While relatively newer mortgage accounts could face greater debt servicing stress from higher and larger outstanding loans, but the risk of default remains low. And that basically sums up the entire Financial Stability Review. If you really are the kind that likes to read this kind of stuff, you could. If not, I've sort of summarized it up for you. Really good for us to build fundamental understanding from the market before we head into 2024.